Good morning and welcome. And more importantly, thank you for taking the time to join me this morning. I sincerely appreciate how busy your lives are, and I'm thrilled with how many of you have registered today for the session. I'd also like to welcome Seb Bilo and Victoria McLean from WHEB. Seb is a partner at WHEB as well as head of research, and many of you have interacted with Seb over the years since Pengana brought WHEB to Australia. Victoria is a more recent addition to the team, having just joined WHEB in July, but certainly comes with terrific credentials and experience as well. Today, Seb and Victoria will take you through a brief overview of the strategy, which I know many of you have an excellent feel for. However, a recap never goes astray. They will talk to some stock stories which I think are particularly relevant to Australians. And then the most challenging part of the session will be for them to provide their impressions of COP26, which has just closed in Glasgow. Was it a success, a disappointment, or something in between? WHEB, I believe, has truly led the way when it comes to investing in companies that produce goods and services that deliver a positive environmental and social impact. Nothing is perfect in this world, but the team at WHEB are passionate and experienced, and they will always speak the truth. Before I pass over to Seb and Victoria, I was initially thinking that this could be an interactive session with questions that could be asked along the way. But as we've got about 60 people online this morning, we will have to put those questions and discussion points towards the end. So please type those thoughts into the questions section as they come to mind, and we will ensure there's appropriate time following the formal part of the presentation to answer those questions. Again, thanks for joining us. I hope you get a lot out of this session, and I will now pass over to Seb and Victoria.
Good morning, everybody. It's very nice to be with you. It's a bit dark and cold here, so I'm sure you're enjoying a lovely Wednesday morning, I guess it is for you. So I'm Seb Bilo. I'm partner and head of research at WHEB, and as Karen said, I will be presenting today alongside Victoria McLean, who's an associate fund manager on the Pengana WHEB Sustainable Impact Fund. I will have to show you the required disclaimer, which perhaps I'll let you read at your leisure later on. But I thought I would just start with a couple of comments just about WHEB and the journey we've been on, and then I'll hand over to and a few words about sort of high level aspects of the strategy and our philosophy, and then I'll hand over to Victoria, who will take you through some of the more details of the strategy and some of the stocks that we invest in. So just very quickly about WHEB, for those of you that don't know us very well, and perhaps a bit of a refresher for those of you that do. We are a specialist fund management business. We're totally focused on sustainability investing. It's all we do, and indeed it's all that we will ever do as well. It's the reason that myself and my partners came to WHEB was because we wanted to focus exclusively on sustainable investing, having worked in larger asset managers and other financial institutions in the past. We've been doing it since 2009 at WHEB, but the strategy actually draws its history back to 2005, and I've been working in the field of sustainability with business and investment now since 1994, so really my entire career. And we have been a pioneer in the field of sustainable investing. We were the first to publish an impact report, the first to publish an impact calculator as well, which has become something that's is quite common now in the impact investment world. And we've recently published a white paper as well on what we think impact investing in listed equities should mean. And I'll be talking about that a little bit later as well. So we're all in really when it comes to sustainability, and we've won several awards over the years as well. And we run a single global equity strategy, which is focused on solutions to sustainability challenges, which is available in the Australian market as the Pengana WHEB Sustainable Impact Fund. So just quickly on the team. So here we are. Ted Franks is the fund manager and another of my partners. There's myself as head of research. There's Victoria, who you will be hearing from shortly as an associate fund manager, along with T. Lee as well. And then the team is rounded off with Ben and Claire as analysts. And we're all passionate about sustainable investing. It's one of the things that we look for when we recruit new people to the team is a passion for sustainability and a passion for the opportunity that sustainable investing offers to generate superior financial returns by delivering positive impact on the world around us. And Ted, Ben and myself have worked together now for 6 years, and Victoria and Claire joined us earlier this year. And then another sort of framing point that I just wanted to make at the start is, which is quite important about WHEB and the way that we operate, is that we believe very strongly in the importance of transparency, particularly in the field of sustainable investing. And the reason for that is that everyone, I think, has a slightly different definition of what sustainability means. And this creates risk for us because you and your clients may have a slightly different expectation of the types of companies that we would invest in. So we manage that risk by being super transparent about what we do. So all the companies that we invest in are listed on WHEB's website, along with why we believe each company is delivering a positive impact. We have a lot of information on our website in terms of how the methodology for how we calculate impact, the impact calculator, and as well as all of the engagement that we do with companies. And we also have an independent investment advisory committee, which is composed of, let me move the slide on, sorry, composed of all these various fine people here who are independent of WHEB and are experts in the field of sustainability and investment. And they meet every 4 months to go through our portfolio and make sure that they're comfortable that the companies that we've invested in meet the philosophy and policies that govern the strategy. They can't stop us from investing in companies, but we do publish the minutes of these meetings. So you can actually go onto our website and download summary minutes of the meetings, and you can see if there's been a disagreement or what the nature of the conversation has been. So that would make it rather difficult for us to continue to invest. We'd have to have very good reasons to continue to invest in a company that the advisory committee felt was not consistent with our policies. So there's a real sense of accountability really to our advisory committee, and through them really to our clients as well. And that's pretty unprecedented. I don't think anyone else still provides that level of sort of transparency and accountability. So then turning to the strategy itself, this is a slide which we've had in the deck for a long time, actually. It comes from a lady called Carlotta Perez, who's an economic historian at the London School of Economics. And she has plotted, she studied industrial transformation going right back to the original Industrial Revolution back in 1750. And the point of the slide really is to demonstrate that actually creative destruction, the famous phrase coined by Schumpeter, is an inherent characteristic of capital markets, and that this is a process that goes on all the time. And in many ways, the latest industrial transformation, the transition to a zero carbon and more sustainable economy, is just another of these transitions. And we presented this when we started sort of 9 years ago to kind of help people feel like, well, what we do isn't that different. You know, it's kind of part of this long history of change, which is true. But I think it's less important to reassure people now, because I think it's become quite clear that this is now happening. It used to be, we used to talk about it as an investment belief. And I think now, although we're still in the very early stages of this transition, it is clear now that there is a change happening in the economy. And the focus of our strategy is all about investing in the listed companies that are enabling this transition to happen. And by enabling it, they also benefit from it because they're selling more of their products that enable the transition to happen. And therefore they make increase their revenues and benefit from that transition. So that's the kind of a key framing condition of our investment strategy. And then the way that we organize ourselves is around these 9 investment themes. So we have 5 environmental themes across the top there, areas that link to sectors like in the industrial sector, to transport through our exposure to sustainable transport, to utilities through water management, for example. And then we also have social themes as well at the bottom there. And they tend to be more defensive sectors like health. So we have a nice balance across the portfolio with some exposure to industrials and some exposure to more defensive sectors like health as well. This next slide is in our annual impact report. And what we're trying to really illustrate here is we set up our 9 themes really back in 2005. Since then, a number of other frameworks have been developed, including, of course, the UN Sustainable Development Goals. And our 9 themes map onto 7 of those Sustainable Development Goals. So the companies that we're investing in, the products and services that they sell, are directly supporting the achievement of 7 Sustainable Development Goals that you can see at the bottom of the chart. And every year, we collect data on the actual impact that companies that we're investing in are having in the real world. And you can see that information at a high level across the strategy as a whole on this slide. So for example, this is 2019 data here, 300,000 megawatt hours of, no, this is 2020 data, sorry, 300,000 megawatt hours of renewable energy was generated that's associated with our investments. And you can read the rest of the data. That's data we collect every year. And then the final slide before I hand over to Victoria, in many ways is kind of the most important. So I hope it gives you a very clear sense of the kinds of companies that we invest in. And what we've done in this chart is to basically categorize the listed companies around the world into these 3 broad buckets based on the externality, the negative externalities they create and the positive impact that they have. The businesses on the left are businesses that we consider to be at risk of a permanent loss of capital as the market moves away from the products and services that they sell. These are businesses, of course, that sell products that have a huge negative impact. The fossil fuel industry, we can also put tobacco, sugary drinks manufacturers into this category. Of course, we don't invest in them. We think that their days are numbered, really. We then have and that's about 20%, slightly less than 20% of the market. And then you have this big category in the middle, which we call transitioning, which represents about 60% of the market, often including businesses that have a strong ESG profile. So businesses like Apple, Marks and Spencer, Unilever, widely regarded as leaders when it comes to ESG, but fundamentally, the products and services that they sell, although we all use them, I'm sure, you can't claim that they're providing a solution to a sustainability challenge. So Unilever, soap and ice cream broadly, people love soap and ice cream, but they don't provide a solution to a sustainability challenge. What we focus on is the companies on the right-hand side, about 20% of the market, where every time they sell another product, you're getting a cleaner, healthier, or safer world. So Aptiv sell components that go into electric vehicles. Arcadis are an environmental consulting firm. TPI Composites sell wind turbine blades. And there's that lockstep relationship. So they're enabling the transition, and by enabling it, they're also benefiting from it because they're selling more of the products and services that they manufacture. So I hope that's clear. And I'll now, obviously we can have questions at the end. I'll now hand over to Victoria.
Great to be here and see so many of you. Let me just share my screen. Hopefully that was a seamless transition. So carrying on from what Seb was saying, I think the positioning in factor terms for us for the portfolio is really an outcome rather than a target. But taking into account some of the things that Seb has touched on, I think it makes intuitive sense based on some of the fundamental characteristics that we're looking at. So taking quality as an example, some of the key elements of superior returns and therefore an overweight to quality characteristics. And again, as I've touched on, part of the underlying philosophy of the portfolio is that link between positive impact and the growth drivers of the business. And I think from that perspective, we'd be looking for companies that have a superior growth profile, and that's correlated with that growing impact. And you can see that really in that revenue growth of the strategy compared within the index. Mid-cap has really been the sweet spot for where we've been seeing those opportunities. And that's resulted in overweight in the $2 billion to $20 billion market cap range and an underweight to some of the mega cap stocks. The other notable characteristic of the portfolio is the high active share, and that's driven by the relatively small overlap between our universe and the index. Just as with the factor positioning, the sector allocation feels like a relatively intuitive outcome of the focus. And as Seb touched on, healthcare is clearly an area where there's a lot of opportunity for impact. And I'll come on later to an example to highlight how we think about that sector. Industrials, similarly, has been a great source of opportunity for us, and it's the largest overweight relative to the index. Our focus is typically on companies whose products enable the transition to a more sustainable economy. And many of these enablers sit within the industrial sector. So for example, you've got companies like Vestas, which is one of the leading manufacturers of wind turbines, and a customer of TPI, which Seb has just touched on. And that's one where the product has a very clear and direct impact. We also have companies like JB Hunt, which is a logistics company leading in intermodal transport, and that involves transitioning freight from truck to rail, which is a much more environmentally preferable method of transport. The fund is underweight to technology. That's quite a popular sector in a lot of ESG portfolios, partly because the emissions are lower than things like industrials, so it gives you a sort of preferable profile from that perspective. But the way that we look at it, we don't see companies such as social media and search engines as being particularly impactful. And actually, in many cases, we take quite a dim view of their ESG practices as well. We do have 9 holdings in the sector, and it's our third largest exposure overall. That includes software type businesses, so companies like Autodesk, which makes computer-aided design software, and also more hardware-related businesses, things like Infineon, which is part of the semiconductor value chain and particularly focused in autos and EVs. Geographically, we don't take large positions, so overall, the portfolio has a very similar shape to the index. And in terms of thematic positioning, as Seb highlighted earlier, we really think about impact in terms of themes. And hopefully this pie chart shows the diversity in the portfolio, both by theme and sub-theme, and also perhaps illustrates more clearly those kind of exposures than the industry breakdown itself does. It also gives a bit more insight into how we think about achieving impact. So for example, that could be in terms of efficiency in manufacturing, environmentally preferable products, reducing costs in healthcare, or providing preventative care. And again, I'll try and touch on some examples of that with the stock examples later on. The next slide just gives you the top 10 positions within the portfolio, and I won't go into this in too much detail now, but happy to take questions on the end if there's areas of particular interest. But I would just point out, some of the thematic exposure we've got in there, just demonstrating the types of companies that we're investing in terms of the impact and diversity of that exposure. And instead of going through these in detail, I'll go on to some case studies that hopefully illustrate that impact side in a little more detail. The first of those examples is MSA Safety. That's a company we've owned since 2012. It's a supplier of a broad range of safety equipment, and the thesis is really built around the demand that comes from an increasing focus on safety regulation globally, but also particularly in emerging markets. MSA are in an excellent competitive position because of the high level of product innovation, which enables them to stay ahead of the curve. They also have quite a diverse range of end customers, including fire departments in Australia. So this would have been very relevant around the time of the bushfires last year. It's also a company that we've been engaging with from an ESG perspective. One of the key topics has been their approach to the use of chemicals known as forever chemicals, which have been linked to cancer or increased incidence of some cancers in firefighters. Now, MSA don't use these chemicals in their own manufacturing process, but they are working very closely with their supplier of technical fabrics to encourage development of materials that don't have these chemicals in them. And actually subsequent to that engagement, 2 sub-suppliers have launched alternatives, which from our perspective is a really positive development and is demonstrating that the company is really taking a proactive approach to this and a leading position compared to peers who often aren't even aware of the issues. We've also been engaging on governance. This is an area where MSA is perhaps slightly lagging, but we're encouraging improvements towards best practices. Next example is DSM. It's a specialty chemicals company focused on ingredients used in nutritional and pharmaceutical products. And 2/3 of DSM's products have explicit sustainability benefits. So examples would be natural taste enhancers that can replace salt content. And Unilever is a customer that Seb highlighted, they're well known for their sustainability focus, and it's companies like DSM that are enabling that. Similarly, they sell a nutritional ingredient based on the fiber found in oats, and that can be added to things like cereals to improve their nutritional content. And again, you see companies like Nestle in their own marketing to customers and their marketing to investors talking about that focus on improving nutritional value of their products as part of their own drive for sustainability. But the product that's of particular interest to us from an impact perspective is the Bovaer product. It's a nutritional solution in cow feed that reduces methane emissions. Methane, 28 times more powerful than CO2 in terms of its warming effect, and cattle and other grazing animals contribute about 40% of the annual methane budget through burping, believe it or not. Bovaer suppresses the enzyme that triggers methane production, and for dairy cows, that can reduce methane production by up to about 30%, and for beef cows by up to about 90%. Now, that evidence is based on 48 peer-reviewed studies that are published in independent journals. And that speaks to something which I'll touch on later, which is quality of evidence. That's often lacking. So it's really great to see that from DSM in this instance. Third example is one of our larger holdings. So you can see from the enterprise value, this is definitely not in the mid-cap range, and it's actually our largest within the portfolio from a sort of market cap perspective. Now, often in healthcare, when we think about impact, it's probably things like curing cancer that spring to mind. But the potential for impact is much broader than that. So it's not just about what disease you can cure. It's about how broadly can that medicine be used. Is a company enabling that medicine to be available in low-income countries or to low-income populations within developed markets? Or is it only available to those that can pay a hefty price tag? The global vaccine rollout was a perfect illustration of that challenge that the poorer countries face in accessing treatment that we often take for granted. And it was also a very sad reminder of the differences we see in our own economies in terms of equity and access to healthcare. Other important areas within health are cost. So as populations grow, there's a growing burden in terms of how much it costs the state to treat all of the things that can go wrong in old age. And we see a growing proportion of GDP going to healthcare spend, particularly in OECD economies. Now, Thermo Fisher is an example of a company that touches on various aspects of health impact. It develops technologies that are used in drug discovery, in research labs and clinics. And one good example is PCR testing, which was widely used in the COVID response and played a really critical role in monitoring the spread of the disease. All of that is enabled by consistently high levels of R&D spending and really deep industry expertise, combined with very strong customer relationships. Now, there was some concern in the market about a post-COVID demand cliff, but at a recent Capital Markets Day, management actually upgraded their long-term growth guidance. So that was obviously really positive for us from that long-term time horizon perspective. I'll pass back to Seb now, who is going to talk a little bit about some of the challenges within impact investing.
Okay, thank you, Victoria. Now let me just get my slides up again. Hopefully you can see that. So one of the things that Karen asked us to do was just to address a couple of sort of hot topics, if you like, in the field of sustainable investing. And one of these is around the issue of greenwashing. So I think probably some of you have come across this gentleman called Tariq Fancy, who is the former Chief Sustainable Investment Officer of BlackRock. And he wrote an essay called The Secret Diary of a Sustainable Investor, which is about 40 pages long, and I've read it. And in it, he's very critical of sustainable investing, and he describes it as being a bit like wheatgrass, treating a cancer patient with wheatgrass, which, if you think about it, is actually worse than nothing. So because the patient is not getting proper treatment, they're taking wheatgrass because they think that's treating them effectively, and so they're not getting the real prescription that they need. And he thinks sustainable investing is a bit like that. It's being sold by fund management businesses to the public. All you have to do is invest sustainably, and you don't have to worry about regulation. We've got it covered, kind of thing. And of course, we need regulation. We need all those things. But Tariq Fancy really dismisses the entire industry, which we think is unfair. There are definitely examples of greenwashing out there, perhaps coming indeed from his own former employer as much as anything. But we do think there are examples of good practice as well, where real positive change and impact is being delivered. And one of the things that we've done, and I mentioned it earlier on, is we've published what we call a white paper on what we think impact investing in listed equities should consist of. And I won't go through all of this model which we talk about in the white paper, but just to touch on a couple of points. The first is that we think if you are investing in impact, you have to be able to demonstrate intentionality. Your intention is to deliver positive impact, and you can do that in two ways. One is by investing in businesses which themselves deliver positive impact. That's the one in the chart, and that you need to measure and report that, which is 2. So that's one dimension of it. And then the second dimension is when we call that the enterprise impact, because it's being delivered by the companies rather than us. And then the second dimension is what we are doing at WHEB to amplify that impact. And we deliver that through engagement with companies. We deliver it through engaging with regulators. We absolutely believe we need regulation to help accelerate the shift to a zero carbon economy. So we think that there are our riposte, if you like, to Mr. Fancy is that if you look for investors that are trying to deliver positive impact, measure it, and at the same time are also engaging with those companies, engaging with regulators to try and accelerate this shift, then that's where real change can come from. The other way that greenwashing is being tackled is through regulation, more and more regulation. This is a slide that we've based on a very recent discussion paper produced by the UK regulator, the FCA, they've published this as a consultation paper because their plan is to develop regulation on the labeling of investment funds and also the disclosure requirements of different investment funds. And their proposal is to structure it into these 5 different types of investment funds, ranging from, on the left-hand side, funds that aren't promoted as sustainable at all, through responsible, transitioning, aligned, which would include investments in taxonomy. There's already a European taxonomy that lists the kind of environmental activities that qualify. We're going to have a similar one in the UK. And then on the far right, impact, where you have to be able to demonstrate this intentionality that I talked about earlier on. So that's one framework that in the UK, as I say, it's out for consultation, but that the regulator is trying to organise the market a bit better. And similarly, in the EU, the Sustainable Finance Disclosures Regulation, which has these articles, and you can see at the bottom of the slide here, each of these funds will fall into one or other of these different articles at the EU level, either Article 6, Article 8, or Article 9. And the 2 regimes are intended to be consistent, we hope, but slightly different at the same time. One of the consequences of Brexit is we have to have our own system now in the UK. But we think this will help, at least in some ways, to deal with greenwashing. And then the other topic that I wanted to just touch on quickly before handing back to Victoria is around Glasgow and the outcome of COP26, which of course was just a few days ago. I was actually out in Glasgow at the end of the first week. We were participating in a fringe event there, and it was great to be there. It's you definitely felt the sense of excitement and importance, really, of the event. You know, the pressure of the changing climate. I quite like this slide. The Glaswegians want to keep Glasgow cold, wet and grey. And when we were there, it wasn't cold at all. It was still wet and grey, but it wasn't cold. And you know, Greta and the other protesters out on the streets. And I think overall, you know, our sense was there was lots to be positive about, lots of announcements, the $130 trillion that Mark Carney has organised in the GFANS network. You know, certainly room for some skepticism about some of those pronouncements, but also a real sense of momentum as well. And John Kerry, at a dinner speech that I was at, was saying how he felt quite optimistic, partly because of the involvement of the private sector and the ambition, the positive ambition of the private sector, which was sort of interesting to hear. And in many ways, actually, the governments were really the laggards. But even there, we saw some important new commitments. And I'm sure you saw this research from Climate Action Tracker. If you haven't, then it's very good. And basically, their conclusion was that if we take a very optimistic view and assume that all these commitments are delivered upon, then we would get to about 1.8 degrees of warming by 2050. If we take a more skeptical view and just focus on what governments have committed to by 2030, then we will still be on a 2.4 degree track in trajectory in 2030. So improvements from where we were after Paris, but still quite a long way to go. And you know, we are already at 1.1 degrees, and we're already seeing significant impacts. I think most people have come away from Glasgow thinking like 1.5 is still alive, to coin the phrase that they were using there, but really only just. And we do need to see a lot more progress. And we've got Egypt, COP27 in Egypt coming up next year, and people are already saying they want to see renewed commitments, improved commitments in advance of Egypt. So we do need to see that if we're going to keep or at least manage to get to the 1.5 degree target that we're all hoping we can achieve. So with that, I will now hand back to Victoria to finish. Thank you.
So climate change has been very much front of mind in terms of progress or lack thereof. But sustainability is a much broader topic, and demand for solutions to global challenges remains high in other areas. We have seen major progress over the last decade on many fronts, but COVID has unfortunately resulted in some of that being undone and has in fact created some new challenges of its own. So this slide is perhaps a bit of a sobering one, but I think the message is worth remembering that there still is a lot to do. So electronic waste is one example. That's the sort of the little diagram, probably I would say brown, in the top left corner. So COVID has created huge demand as people have shifted to working from home. But all of that demand comes with additional cost in terms of the waste that it's creating. And only 23% approximately of electronic waste is currently recycled. So clearly a long way to go on that front. I think when it comes to energy efficiency, it's a much more visible topic. You know, we all have energy ratings on our appliances that tell us, are we buying something that's A-rated and wonderful, or F-rated and planet killing? But the pace of that efficiency improvement isn't enough. So we need to go from a pace of about 2% per annum. This is the little box in orange, to about 3%, which doesn't sound very much, but that's a 50% uplift in annual improvements in efficiency, which isn't a small thing. And it's particularly important when it comes to buildings. Other areas have seen, unfortunately, quite significant setbacks. So education is one area, health, particularly maternal health and child health, is another. And while climate grabs the headlines, other areas of environmental sustainability are still lagging in how much attention they receive and how much progress is being made. So there's some stats in the bottom left corner on water resources, which still has, again, a long way to go, and biodiversity, which doesn't receive anywhere near as much attention, but is a significant and is kind of joined with climate in terms of how those interact. And that, the focus on that is increasing, and that's positive, but still some way to go. So what does that mean for impact investing? Well, the key thing I take from those challenges is the need for innovation. We need solutions, and as the health-related R&D stat in the bottom right suggests, investment in research and development and investment in innovation is essential. And that's where we see the opportunity, because it'll be companies with the deep expertise and that purpose-driven mindset that can be at the forefront of driving those changes and providing the solutions. I think scale is another thing that makes us optimistic, specifically around the opportunity in listed equities. These are large-scale challenges, and localized small projects aren't enough on their own. The scale of the challenge requires multiple actors acting together, and that includes listed companies. And it's in fact especially listed companies, because scale is exactly what they can bring. And what about the supply side, the providers of impact portfolios? The Global Impact Investing Network provides an annual survey on the state of the impact industry. And 10 years ago, the majority of respondents felt that the impact industry was in its infancy. And now clearly the majority see it as growing steadily. And public equity in particular has grown at a 33% annual rate. And appetite doesn't seem to be slowing. But I think based on what we see, genuine impact investing in public equity done properly or done well is probably closer to being in its infancy because of some of the challenges that it still faces. And by properly, we mean a thorough, analytical and evidence-based approach to measuring and reporting impact. And that's something that gets significant focus at WHEB. And even for us, we still see it as a developing area where we can continue to grow. So there are a number of challenges for impact investors. And again, the GIN captures some of that in its annual survey. And those challenges apply for clients as well looking to invest in impact. Measurement is generally seen as the most significant, and it's seen improvement and moved forward, but it's still seen as the greatest challenge for impact investors. How do you quantify the exact change that a company has? How do you compare different impacts? These are all the kind of questions that investors face. That's compounded by the inconsistency, accuracy, or lack of availability of data. There's also a question of sort of availability of talent and of skills. And one of the things that the survey flags is that one of the constraints is that professionals with relevant skill sets. So not all fund managers have the resource to be able to do this and to be able to do that analysis in the depth, certainly that we try to go through. Positively, though, I think it seems like impact investing is an area where there's a willingness to collaborate and to drive improvements in the industry. We're seeing more effort to drive systems level change as well as enterprise level, which is an important distinction that Seb touched on earlier. And we're doing that, for example, through joint engagements, engagement with regulators and with those standard setting bodies. Seb is actually a member of the Listed Equity Working Group for the Global Impact Investing Network, which is focused on defining what impact investing in listed equities should involve. We are also seeing efforts to standardize reporting and help with impact measurement. And we're seeing companies providing an increasing amount of data and evidence to support those claims, as we saw with DSM. So the system needs to change, the global economic system, but also the financial system. And I think historically investors have seen themselves as slightly separate to that global ecosystem. And that's evidenced by the view that some still hold that ESG is not our problem, let alone sustainability. But I think that view is changing. And that does make me positive about the outlook for impact. We're seeing more opportunities on the company side. We're seeing it become a greater focus for clients. And we're seeing more attention being paid to those claims of impact and actually analysing them. The hope is that taken all together, that results in increasing positive impact and progress towards meeting those global challenges. We know what we need to do, but we need to do it at real scale and with a bit more urgency. And I think impact investing in listed equities plays a very clear role in that. So with that, I think I'll hand over to questions.
Okay, thank you both, Seb and Victoria. I think it was really good and quite comprehensive. And I think, as usual, these sessions tend to open up a lot more questions in people's minds. And I'm sure this is the same sort of, I guess, almost obstacles that advisors are facing with clients who are looking to invest in this space, but the depth of understanding that's required, and it's a much bigger story than just, I guess, an investor wanting to be an ethical investor. So I just tend to find, I know when I started at Pengana 2 years ago, I thought I knew a fair bit about ethical investing. I knew nothing. And every day for me, I'm learning something new. So these sessions are really, really useful, I think, for clients and for me as well. And I do have a few questions that are coming through. The first question is from an advisor who's actually looking to make an allocation to WHEB on behalf of one of their clients. And this is a question that does come up regularly. And again, there's no simple answer. It is about performance. The advisor is very focused on long-term performance, but has noticed there has been a recent lag with WHEB, particularly against the index. Looking for a couple of answers of the whys, but also the future. How does the next 12 months look from a performance perspective? If you can answer that.
Yeah. Well, I think maybe I'll have a stab at that. I mean, I guess the benchmark for the strategy for the fund is the MSCI World, and we use that really because I think most people, when they think about global equities, that's the kind of benchmark that they use. And our proposition is that over the long term we should beat the benchmark. We think that by investing in companies with a positive impact, you should expect to outperform, because these are the businesses of the future. Having said that, of course, we are very different to that benchmark. We're 98% active, like Victoria said. We have no exposure to the FANGs, very mid-cap oriented. And over recent months and really last couple of years, the FANGs have been responsible for a very large part of the performance of the MSCI World. And we just don't consider them to be positive impact businesses, so we wouldn't invest in them. So I think in light of that, we think actually that the performance has been pretty good, actually. If you're mid cap and you have no FANGs, then it makes it tough to keep up with the MSCI World. And then the other thing that I would mention just this year is that we have seen after lockdown, the sort of reflation of these economies around the world, and early cycle sectors have tended to do very well, and that includes things like financials and energy, oil and gas. And of course, we don't have any exposure to either financials or oil and gas, so that's also been a bit of a headwind for us. So with all that, I think, obviously we can always do better. We always aim to do better, but we think we've done okay, actually, over the last 12 months or so.
Okay, excellent. And if there's any further questions on that, please just shoot me an email and we can give you an even broader response. There's another question that's come through in relation to one of the last slides that Victoria put up, and that was about that COVID has wiped out 20 years of education gains. How does WHEB look to address that within their portfolio? Obviously, it's of interest to WHEB. It's part of the social side of the portfolio.
Yeah, so that report is a global report. So I think some of the wiping out of education gains was probably focused quite a lot in emerging markets. So it's a big stat, but I think in terms of the focus of the portfolio, we'd be looking much more at developed markets and education in that sector. And I think a lot of what we're looking at is probably more the higher education, so post-school rather than the kind of formative years, if you like. And one of the things that has been a big focus is the ability to access education in a more flexible way. So the shift to online, well, the shift to online during COVID has, I think, helped people realize that that's a much more usable business model. So you're seeing companies talk more about kind of hybrid models or providing higher education online at a lower cost, which means you were able to provide access to a wider range of people and provide those opportunities to a wider range of people. And I think it's also very relevant in the kind of the post-education market in terms of further training. So often these are people with jobs who are looking to reskill, and I think that's going to be very relevant in future as we see more automation, people having to change jobs more. I think that's another opportunity where we see that's probably where we see the types of companies that would be investable to us rather than that early years education.
Excellent, thank you. Further to the performance question, I have just had another inquiry, more from the benchmark perspective. Why do we not use a more relevant benchmark to the fund, like an ethical benchmark?
Yeah. I mean, I guess there's no perfect answer on this. I mean, we have thought long and hard for many years actually about this. I mean, I guess fundamentally our proposition is that we think we should be able to outperform in the context of global equities. And I think the problem with when you choose an ethical benchmark is that I mean, maybe this isn't the motivation, but I think sometimes people think that you're choosing a sort of special benchmark that helps you look a bit better. And in a way, we just want to demonstrate that this is a good way to invest. I mean, obviously we love our ethical investors and the people and most of our investors are people who care deeply about sustainability. But we also want to be a product that appeals to people who perhaps haven't really thought about it yet and are just getting into it and don't necessarily want to, they want to see performance as well. And we think we should be able to deliver those things. So that's why we chose the MSCI World, but it's not perfect and it certainly doesn't explain our performance. So we don't try and use it to explain our performance, but it's just a sort of over the long term, we think we should be able to outperform. That's really why we've chosen that one.
Yeah, excellent. One of the stock stories that you talked about today, DSM, one of the questions that has come through is this a product available to farmers in Australia? It seems to be in Australia, I guess, and this is probably what the question's alluding to, that yes, we have resource efficiency problems, we have waste problems, but always what seems to come up is farmers being anti anything that's improving the world because they like to do things how they've always done them in a lot of cases, although that is definitely changing. So the methane problem here is something that's often brought up. It was brought up quite strongly in the press prior to Glasgow. So is DSM a product that is distributed in Australia? Do you know?
I don't know if it's sold there. From what I can see, they have done tests in Australia, so maybe watch this space.
Absolutely.
I think it's I think it's still being registered, isn't it? I think certainly in the EU, it's just still being registered. I think it's available in Brazil or somewhere that you can now use it. They announced that they're going to build their factory for producing it in Scotland. Actually, they timed that one with over Glasgow as well. Yeah, I think that's right. I mean, the other product which I think we should mention with DSM, probably still relevant for Australia as well, is around fish farming. They have this product called Verimaris, which is a fantastic product. It basically, because our salmon are typically fed, wild caught fish are then fed to farmed salmon, which is obviously very damaging from a biodiversity point of view. And they basically produce algae in big tanks, and they use that to feed to salmon instead of the wild caught fish. So it's a fantastic story from a kind of biodiversity point of view. So DSM are really building their whole strategy around sustainability, and these are two of their big new products that they're bringing forward.
Okay, excellent. Another, I think, a really good question as well, particularly for people who aren't as familiar with the fund, is your risk management strategy about how you allocate, your positions in the fund.
Mm-hmm. Yeah, so we have we have two main ways of managing this from a top-down perspective. So we manage most of it is bottom up. So the kind of the focus of the fund really is on trying to find the most impactful businesses with the strongest competitive position that offer the best return over 5-year plus time horizons. So that's kind of the core of what we're trying to do, but we do try and manage that within a framework. And some of the parameters that we have are, for example, around our geographical exposure. So we manage our geographic exposure quite close to the MSCI World. We have a sort of composite benchmark that we use. But the geographical exposure is close to the benchmark. We limit the exposure. You can't have more than 30% in any individual theme. So you cap the amount that you have invested in anything. You don't have to have exposure to every theme. So we have been absent from education, for example, for some periods. And then we manage the position size quite closely as well. We have 3 levels of conviction in the fund, ranging from, I think it's just over 3%. Victoria might have a more precise number, but I think it's about just over 3% down to about 1.5%. And so we kind of control those positions quite closely. And if a position moves above 3%, then we'll start taking profits, and the inverse on the other end as well. So those are the main ways in which we kind of manage the portfolio. I'm trying to think if there's anything else. Those are probably the main ones.
Excellent. Yeah, and I think I can send some framework through on that as well to the advisor. The other question that's come through as well is probably more a general question. I guess your thoughts around nuclear energy as well. Again, a very patchy history in Australia.
Yeah, we don't consider it to be, we have a cleaner energy theme, and we don't consider it to be a form of cleaner energy. And so it doesn't qualify for the strategy. It's a live debate in the UK as well. We've got these new technology for these sort of mini reactors, which everyone's getting very excited about. I think for us, a lot of our skepticism, I mean, obviously we're concerned about the waste issue, but a lot of our skepticism comes down to the price as well. I mean, we're building this new facility in the UK, and the price is just so much higher than renewables now. Renewables are just so competitive, even with storage as well. So there's a question mark over the technologies just from a kind of economic point of view, let alone the environmental issues as well. So, but for us at the moment, it doesn't qualify.
Yeah. Okay. You could probably write chapters on that as well, I assume.
Yes.
As well. So I think in the interest of time, we've pretty much covered most of the questions that have come through. There's a couple I can get back to individually as well. I really just want to thank everybody again for their time, and especially to Victoria and Seb as well. We will be sending the presentation through to all the participants as follow-up, along with your CPD certificates, which are always useful. And we've also got a terrific video that we've just recently put together as well. It goes through 3 minutes and 22 seconds. So nice and short and sharp, and definitely something I think that's worth sharing with your clients, so they get a little bit more feel for what WHEB do and how they really see sustainable impact investing, and how totally responsible that they are for looking after your clients' money in that space. There's no shortcuts taken. Everything is done just so carefully. Many of you I have introduced to the impact calculator on the microsite of the landing page of WHEB as well. And I think one of the other slides that was thrown up early, well, it's all about calculating that impact. And you can actually key into that, that calculator how much your clients invested and what personal impact they would have made on social and environmental themes during a 12-month period, and actually can go back even further. So when, as an example, if a client invested $100,000 during 2019, they would have saved, I think it is, 11,000 megawatt hours of renewable energy. 16 tonnes of CO2 was avoided, so that's great from an individual perspective, and 140,000 litres of clean water was made available for reuse. but many of us have been working in the managed fund space for many, many decades, some of us too many decades that want to be remembered. But what I love about managed investments, it's all about pooling your money. So it's not what just an individual has, I guess, contributed to the future. It's the strategy as a whole. So one of those early slides showed up that, your own individual contribution may not look like a massive amount, but when you pull it all together, it's 300,000 megawatts of renewable energy. It's 320,000 tonnes of CO2 has been avoided. 7.5 billion litres of water has been cleaned for reuse. So, having your clients, I guess, invested in WHEB is actually having a massive impact overall. So it's certainly something I think that that clients would be, I guess, really appreciative to be involved in. And it's certainly something that they can't necessarily do themselves as well. And just a final note from one of our advisors, which is lovely. Thank you, Seb Victoria. Very enlightening presentation. So as always, we welcome questions. Seb and I have been going backwards and forwards about a particular stock for over a week now on behalf of an advisor. That's what's exciting about this space. It does raise questions. People are looking for information, looking for answers. And I certainly always appreciate the time and effort that Seb and the team and Victoria now, can't wait to see you in Australia as well, put into the effort. They really want their investors to believe what they're invested in. So feel free to contact us at any time with any questions that you might have about the strategy or the space in general. So thanks again, everybody. We really appreciate it. Again, as I say, your time. I do know how precious it is these days. And I look forward to seeing you all early next year, hopefully, and actually shake hands perhaps as well. We're really good. Thanks, Seb. Thanks, Victoria. And we'll see you soon.